Economist with CMHC. Prior to joining CMHC in 1999, I did work on Bay Street. So, working with different types of investors, building financial plans, um, and really understanding that a plan is critical if you have any chance of succeeding in life. So, planning quite important. Yeah, made a lot of contacts since joining CMHC, including connecting with Steve, and looking forward to our conversation today.
Thanks, Ted. And of course, I'm a mortgage broker. I've been in banking for 30 years and mortgage broker for the last 16 now, and also founder and editor of Canada Mortgage News. So let's get right to it. I'm just going to go through the itinerary very quickly. It's Financial Literacy Month in Canada, and we were just talking about that before we went live, Ted and I. And it's the 10th anniversary, believe it or not. And it seems like 10 years is a long time, but maybe not long enough. I don't think we have enough of this. How do you want to say focus or attention to financial literacy? So I think it's going to be a good topic of discussion here. Um, okay, we're going to talk. I'm just going to go through itinerary very quickly. We're going to talk about interest rates, savings, debt and budgeting trends, good debt versus bad debt. That's one of my favorite subjects, by the way, and how the debt affects the economy, house prices, mortgage delinquency, bankruptcy and consumer proposal. Well, let's hope nobody's going through that, but as we know, that is, that does come up, and we can tell you the difference about that. Interest rate, Bank of Canada, where that's going, and the risks. I think we kind of know where it's going, but we'll talk a little bit about that. Second line of defense. Is it necessary despite the recent rise in savings? So this is going to be, I want to hear Ted's opinion on this one. And then, of course, where's the problem? Disaggregating debt asset ratio by age and income. Trends in financial literacy, something we just talked about. Hopefully we can improve that. And the disruptions coming post-COVID. I think that's going to be, we have enough here, a lot to unpack. So Ted, if we can get started, and maybe I'm going to hand it over to you. Let's talk about interest rates and savings and debt and budgeting trends. Where do you see, interest rates headed? And I mean, they're obviously quite low, but what's your opinion?
Yeah, there've really been three very interesting macroeconomic events, Steve, that have transpired since the early 1990s. We know about inflation targeting, central banks setting inflation targets around the world. That was a pretty big event that we saw post 1995 across a number of economies. The second big event was electronic commerce, and thirdly, globalization, freer trade. Believe it or not, all three of these events have really worked to really restrain inflation and in turn restrain interest rates. So it's not surprising that since the 1980s, we've seen interest rates trend lower. We've seen savings move down quite dramatically because the incentive to save drops when interest rates move lower. And not surprisingly, debt started moving up thereafter. Coincidence? Probably not. I think there is a real linkage here. And to amplify this problem, to make this problem even worse, we know that few households, or the majority of Canadian households, don't have a budget. So in essence, they don't have a plan. This is really a concern, particularly given that the Bank of Canada has just a few weeks ago indicated that interest rates are going to stay very low for an extended period of time until 2023. Some have suggested it could go well beyond that. You know, recall the financial crisis in 2008. We didn't see interest rates move up until 7 years thereafter. So there is a possibility that rates stay down for an extended period of time and could even move lower. So what does that mean relative to the given the relationship that we've seen with interest rates, savings, and debt? Well, it means that there is a risk that debt could continue to climb. Um, and you know, I always say, Steve, and I mentioned it at the outset, building a plan early on in life, getting into good financial habits is critical, and a budget allows people to do just that. And you know, the empirical data is very clear to me. Those who have a budget, 9 times out of 10 stay within budget, and 9 times out of 10 are able to distinguish between what is a need and what is a want, because they see income as being a binding constraint. They don't see income being unlimited, right? It's a constraint, and we have to make choices, and we have to make rational choices.
Yeah, budgeting is very, it's almost like, I think it scares people. It seems to be overwhelming. I've had these discussions with clients over the years many times, and it just seems to be a big task, and you know, it's a big spreadsheet, and how do I approach it? And of course, who wants to be on a budget, right? It seems limiting, but I think we have to think about it in a different way. It's almost like you don't want to think about it as limiting. You want to know where your money's going. I think that's probably a better way of looking at it. You know, where is, you know, out of every $100, where is everything going? And savings, as you said, I mean, there's this book that I'm reading. Someone said I should look at it. It's an old one. You've probably heard of it, Rich Dad, Poor Dad. And one of the lines in there is saving is for losers. I'm like, I don't know about that so much. I understand what he meant to say, and well, that was a line. It was kind of straw language, but I understand what he meant to say is that you should be investing your money, making your money work. And yes, I agree with that, but I think you need to start by saving first. You have to have something in your pocket, right?
Absolutely, absolutely. You know, you raise a great point here, Steve, because uh, to have any chance to you know, to save, invest, and even save enough to rent or to buy a home in the future, you know, you need at a minimum a foundation, and a budget is a foundation. So
And so let's talk about the trends. Well, yeah, we did talk about that, budgeting trends a little bit, and savings, and the savings are dwindling, but maybe good debt versus bad debt. Let's explain what that is, if you don't mind, Ted, what, you know, what that means, bad debt and versus good debt.
well, I think you and I probably see it the same way, in the sense that you know, there's definitely, you can't paint debt with one brush, that all debt is bad debt. I think that and when a household takes on debt, and you know, that obviously goes on the liability side of their balance sheet. What you'd like to see is an asset as well on the asset side, so that you know, when you're paying this debt down, you do have an asset that secures that debt, and that generates some stream of income, or some potential capital gain in the future. Um, so I would say that, you know, mortgages are probably good debt, because you've got that liability on the you know, that mortgage, but you also have an asset securing that mortgage. And
Wait a
so,
minute. Wait a
oh,
minute. Are you
oh, we're gonna,
sure? You should be working with CMHC. Mortgages are good. I thought someone.
There's a but here. There's also a but, and we'll get to the but. But I want to give you an opportunity to respond as well. But so that's good debt, bad debt, of course. Here's an example. Okay, I want to go on a vacation. Nothing wrong with going on a vacation, and I want to put it all on a credit card which has a balance of $20,000 on it, and I don't pay my credit card on time. You know, a lot of bad things going on there, right? First of all, having $20,000 as a balance on your credit card being high interest debt is not always the most optimal. And secondly, not paying your full balance is not always optimal because obviously interest accrues on the outstanding balance. But more importantly, if you continue to take on debt for consumption driven reasons, where you're buying a car, you're buying electronics, these things don't really appreciate. There's really no asset there. Then, clearly your debt to asset ratio is not staying stable or going down as it would perhaps if you held real estate, but your debt to asset ratio is actually going north. And that's not good. So these are just simple examples in my mind of good versus bad. Steve, I'm going to throw it over to you in case I missed anything, but that's my 2 cents there.
No, I agree, and I think it's funny. I look at the U.S. We seem to be glued to our screens with what's going on in the U.S. the last several years. Well, for many reasons, but down there, people are refinancing their homes to buy big screen TVs. This is no joke. It's so easy to refinance your mortgage down there. There's a different attitude than there is here. But as they say, we're only 5 years behind the U.S. and we've seen, the debt levels have increased. I'm sort of torn between this because I have a lot of clients, Ted, that borrow money for what I consider good reasons, which are not just to buy their first home, but to buy their second, third, and fourth. And I don't think that's a problem. I'm sure you'll agree with that. Again, you've made it clear, good debt versus bad debt, especially when you're buying some sort of investment, an asset, a performing asset. This is good debt. There's nothing wrong with that. Again, don't get in over your head, within your means. Make sure you can meet the obligations. But I think, there is such a thing as good debt. And restructuring your debt as well, perhaps that's a deeper conversation, but sometimes we can take our bad debt on our house, let's say, and restructure it so that it can become a tax deductible expense legitimately. But we'll talk about that another time. It's a bit more involved, but that's my opinion on good debt and bad debt.
The only additional thing, Steve, I would like to add is the but. And so the timing of a mortgage origination also matters. So what do I mean by that? Clearly, if you are going into the housing market and taking on a mortgage in 1997, that's clearly very different from, taking on a mortgage in 2020. So the timing of that mortgage origination and where you are in the real estate cycle does matter as well. So even if residential mortgage is good debt, and really you've got an asset there, you really need to be wary about timing. And a great example here is I'm going to go in with 5% down in 2020, and leverage when there is a risk that prices could turn on you. And we're already seeing it in the condo space. And in that situation, clearly it doesn't take a lot to get you into a negative equity position if prices drop by more than 5%, right? So, timing, I'm not suggesting that you can time everything in life, but timing matters. But what I would say to someone who wants to get into a property in 2020, spend that extra time to build a bit more savings, okay? I think there is a tremendous value putting 10% down versus 5% down, not just from an insurance premium perspective. Your insurance premium gets cut in half, but your monthly payment, it makes a difference on your monthly payment. So from an affordability standpoint, it makes sense. From an equity standpoint, it makes sense. So anyways, I just wanted to qualify it that way.
I knew we were going to have a disagreement here somewhere. Uh, what you're saying is true. It's accurate, and of course, my philosophy has always been, and I've written this out many times. I've said this to my clients thousands of times. If you're buying a property, forget this get rich quick scheme flipping of the property. I'm just not into that. I mean, there are people that do it, they know what they're doing. These are experienced investors and they understand the risk. But for the majority of us, the vast majority of us, stop watching, the four-letter TV network. I don't want to say it in case someone's watching this, but that's all smoke and mirrors. You know which I'm talking about. This is not true. If you're buying a property, here's the strategy, and it's proven. Buy with the intent of owning for 7 years. Why 7 years? Because it's proven to be long enough to amortize all the acquisition and disposal cost of a property. You're also going to pay your mortgage down in that time, and probably the value is going to go up. You will probably have lived through any up or down economic cycles. So I'm also not about timing the market, and I'm not trying to push people to own, but I think waiting to buy, it's proven to be not always wise. If you don't, not to disagree with you that much, Ted, but I hear what you're saying, and yeah, you should have a savings account, a cushion, a safety net, and I guess we'll talk about that in just a moment in our next few subjects here. Does that make sense?
No, for sure. Can't disagree with you. You should always have a long-term perspective when it comes to real estate, for sure.
Okay, so I'm going to talk a bit about mortgage delinquency, and I mean, you have those stats probably, Ted, and I was looking at some of the reports that came out that are available on CMHC's website. Um, how how are we doing with mortgage delinquency? Is it up, because of COVID? Is it down? Where are we at?
Well, mortgage delinquencies have been, I would say, probably stabilized and troughed last year, and now are starting to inch up. And I suspect that we're going to see that mortgage delinquency rate move higher over the next several quarters, I think. The best predictor of mortgage delinquencies is really the unemployment rate. That's what history has shown. So if you lose your job, your ability to make timely payments is really jeopardized. And yes, the unemployment rate hit a high of in and around 14% in Canada. Several months ago, it has since moved lower, under 10%, but it's still 1.5 times to 2 times higher than what it was pre-pandemic, right? So I think that there is a risk that we will see mortgage delinquencies move up, but I think it's also important to note that they're moving up from a really low base as well. Um, you know, in Toronto, and let's take Toronto and Hamilton as an example, delinquency rates were sitting at 0.09%, right? Those are historically rock bottom rates, but yeah, I suspect we will see that number move up over the next few quarters.
And I was looking at the U.S. numbers. Delinquencies are ridiculous. I think it's 1% or something. It was a really high number. I couldn't believe it. I had to look at it twice. So comparing to them, we're doing good. But again, we're on life support. The government's pumping in all kinds of money to support this, and look, the lockdowns, if you have a business and you can't open your doors, how long can you last for? I hope they direct the money to those people, because that's who really needs it, and especially the restaurants. That's a really hard hit industry. Um,
And that's a great point, right? We're in a second wave now, and we know what the numbers are looking like in Europe, in the United States, even here in Ontario. They've been, I think this morning 1,500 new cases, right? And we were sitting closer to a peak of, what was it, 500, 600 back in the spring. So that's telling. And if businesses close their doors, and this could push unemployment rates higher, and yeah, we could have this could impact delinquencies as well. That's a risk for sure. Yeah.
Bankruptcy versus consumer proposal. Not that we want to go there, but let's talk about that. Um, I'm going to just jump on that real quick, Ted, because I see this a lot with my clients, and I'll give you a typical. There's a big difference, by the way, and I'll give you a typical situation. Um, I get a lot of calls from clients, and they'll say, "Hi, I want to apply for a mortgage," and so you got one that went bankrupt 5 years ago, let's say, and one that had a consumer proposal, let's say 7 years ago. So I'll tell you the difference first of all. So bankruptcy, I think we all kind of know what that means. You basically your debts are higher than the value of your assets, or very close to that, and you can't make the monthly payments. So what do? You have no choice. You can't keep going, in this revolving door. People go bankrupt, whereby all their debts are wiped out. So what happens? Well, you have to reestablish your credit so you can get back on your feet. It takes about 2 years to reestablish your credit. You have to have a revolving line, a loan, or like a credit card, and a term loan, like a car payment. So it takes about 2 years. After that, you're like brand new. Everybody wants to deal with you again. Consumer proposal, a little bit different, whereby the way I like to put it is, you've done the honorable thing. You've gone to see the trustee in bankruptcy, and you've said the same thing. Hey, I can't make I can't manage my debts. And they say, okay, let's do a consumer proposal. What that means is they take a percentage of your income, and they'll put it towards paying off the debt over a period of time. So the debtors will take 70 cents on a dollar, 50 cents, maybe even 30 cents on a dollar. They'll take whatever they want because you're about to go bankrupt. The problem with the consumer proposal is that it lasts for 3 to 5 years, sometimes longer. So you're on this payment schedule. You've done the honorable thing. Like, I respect people that do that, by the way. Not that I don't disrespect people that went bankrupt, but you get nothing for it. This is the unfortunate part. Your proposal, let's say, lasts 5 years. From the date of your last payment, that's when you can start to reestablish your credit. So if you were in a 5-year consumer proposal, it'd take you 7 years to reestablish your credit. Whereas if you go bankrupt, you can reestablish your credit 2 years after the discharge. It's actually very unfair. And I would say to people, if anybody that's listening, or if you know someone, I hate to say it, but look at the bankruptcy. That may be a better option. And the reason that the trustees push people, and I'll use that word loosely, pushing, but direct them into that, is it's easier on them. They don't have to go through a big, selling sales pitch to the bankruptcy court. So, anyways, Ted, sorry if I'm taking over the conversation, but I think that's important to distinguish the two.
Yeah, I think you've covered it well. I have nothing more to add here.
Okay, interest rates. So this is, of course, a favorite topic, Bank of Canada. I think we kind of know where it's going, but Ted, do you want to just jump in on that?
Um, yeah, I mean, I think that, the Bank of Canada has been using this language of slack. There's slack in the economy. So what in the world does that mean to the average person? Well, what it means is that if the economy has the potential to grow at, 1.5%, and it's growing well below that, That means that there is some idle labor that's not being fully utilized. There's idle capital. Um, and when you've got supply outpacing the growth in demand, that tends to put downward pressure on inflation. People's expectations of inflation, you know, are dampened, and ultimately, if inflation is running at the lower part of the Bank of Canada's range, you know, then rates are going to stay down until that slack is absorbed and the economy moves back to potential. Well, that's not happening. We're being told until 2023. And I suspect that, you know, again, this is a forecast. It's not, nobody has a crystal ball. But when I go back and I think about the credit crisis, and I know we can't compare one for one here, both periods, but you know, it took 7 years for rates to move up. And so I suspect we are in a low interest rate environment for quite some time. And you know, Steve, this doesn't even speak to, and we'll talk about this later too, what are the other disruptions that are looming in around the corner here, right? That could put you know, it could put could impose another hit to the economy and to inflation on the way down, right? So so all to say, you know, linking it back to financial literacy, you know, it's very easy to get enticed by low interest rates to say, okay, you know, my income isn't a constraint in my mind because I don't have a budget, and I'm going to borrow however much I need to fulfill a want. It's not even a need; it may be a want, right? You know, that's that's very dangerous thinking in my mind, particularly if you don't have a financial plan. And so it's going to become even more critical over the next decade as rates stay close to zero or very, very low, that we think about what and distinguish between what a want is and what a need is, and ensure that we're not living beyond our means, that we're not biting off more than we can chew. Yeah.
Yeah, it's well said. I mean, rates are going to stay low. I mean, that I guess that's good news in a sense for anybody that has debt, and most of us do. Um, I kind of look at it, and again, staying on the financial literacy topic or mode here, um, when do you borrow money? When do you not borrow? You borrow when rates are low. But what I mean by that is maybe you can, okay, so debt consolidation, it's a little bit of a dirty word. I don't think so. I think it's a smart move. There was a study done in 2005 by Professor Moshe Milevsky, very well known, very smart individual. I love the way he put it, and it was called "These Eggs Do Belong in One Basket." And so what he was saying is that it specifically is talking about Canadians. We have this phenomenon whereby we like to segregate our debts. So I remember my father saying, pay off your mortgage, pay off your mortgage, don't have any debt. And this goes back to what we talked about earlier, you know, good debt versus bad debt. And there's nothing wrong with that. Pay off your mortgage. The best mortgage is no mortgage. However, you're trying to expand your wealth. It's okay to borrow to invest. Well, it's also okay to borrow or consolidate your debts to pay a lower cost of interest. It doesn't matter if you have, um, you know, having four debts, a mortgage, a line of credit, a credit card, a car loan. We know all those non-real estate secured debts are going to have a higher rate of interest. Generally speaking, I know sometimes there's a car loan special 0.9% or something, but the point is, I think it's okay to look at and your situation and say, wait a minute, why do I have you know, four debts when I could put everything into a mortgage that has a low debt? There's nothing wrong with that. And again, trust me, my father, he probably doesn't want to hear me saying this. He's going to say, don't do it. But it makes financial sense. Would you agree, Ted, with that?
Yeah, for sure. Swapping high interest debt for low interest debt it makes a lot of sense. And those opportunities um, do come around, uh, obviously more often in the last decade than what we've seen historically. So for sure, and I've seen a lot of consumers do just that, refinance, top up their mortgage debt and pay some of the high interest non-secured debt off. So yes, absolutely. I think what I'm saying is for simplicity, if you've got $10 worth of debt before refinancing and swapping high interest for low interest, and then you find yourself with $15 of debt, then there's a problem there. And I think, Steve, sometimes we like painting the entire market with one brush and saying debt is a problem everywhere. The reality is that when we disentangle debt by age and by income, it's not a problem across all households. Uh, Tends to be more of a problem for households under the age of 40. And I say it's more of a problem for younger households because they don't necessarily have the asset base to be able to secure that debt. We know that households over the age of 60 have also been taking on more debt, but their net worth and their balance sheet looks a bit healthier. Obviously, they have that asset base. So I think that yeah, the real concern is when rates do drop is what are the younger households with they may have higher incomes but with less of an asset base. What are they doing? And so yeah, so I just wanted to mention that part. Yeah.
Yeah, no, it's a very good point, Ted. Um, Second line of defense, macroprudential policies. Um, Ted, this is your baby. I want to hear you comment on that.
Again, this goes back to our earlier conversation about um, what the relationship between interest rate savings and debt has been historically and will likely continue to be in the next decade. And that is that if we buy into the Bank of Canada narrative that interest rates are going to stay down for 3 years, maybe more, um, or and there's a risk that they could even drop to a lower level. We've got negative rates in some parts of the world. What does that mean for savings and what does that mean for debt? Well, I doubt that relationship historically is going to break down. I think that relationship is going to stay in place, that there is a high probability that debt will continue to move north. And so, we can't use interest rates to manage debt. It's too broad of a tool. We've tried using interest rates in the early 1990s. And I know that I'm going to get a lot of people who don't remember that period who debate with me on this point. But I think there were lessons learned in the early 1990s that you can't use a broad tool like interest rates to achieve a goal of of less debt, or even achieve a goal of, I want slower inflation in real estate, right? It doesn't work. So you need to look at other tools, and macroprudential policy tools are the way to go. So this would include things like stress testing. It would include things like capping GDS, TDS ratios, perhaps increasing credit scores. There's been a lot of macroprudential policies that have been introduced in Canada in the past decade. There is a debate out there. Did they come faster than they should they have come faster than they should have? What we've actually seen, did we wait maybe too long? But in a world of zero interest rates, these macroprudential policies are very much needed, particularly if you want to manage um, specific sectors of the economy. You want to sort of fine tune the amount of inflation, let's say in housing, or you want to sort of manage how much debt households inevitably take on. And because mortgage debt comprises a big chunk of total debt, macroprudential policies seem to have kind of focused more on the housing story. So as I say, there is a real purpose behind having this second line of defense in a world of, very low interest rates.
Oh, it's interesting what you're talking about. I want to stay there for a moment because I have not seen any pressure on credit card companies, to issue credit cards. I mean, if you have a pulse, you're going to get a credit card. And if you have same thing, if you have a pulse, you're going to get a car loan. And car loans aren't 4 years or 5 years anymore. They're 7 years, which is crazy. And I'm seeing that a lot where people come to me after the fact and I'm going, what the hell happened here? You've got all this debt because it's too easy. And then we're making it hard for them to get a mortgage, which to me makes no sense. I mean, I'm going to go back a little bit of history here as well. And Ted, you remember this, 2006, we had, this is a true story, by the way, they're factual. We had 40-year amortization mortgages. We had actually interest-only mortgages. We had 100% loan to value, that's zero down. Mortgages and on rental properties. Remember that, Ted? Like this was not that long ago. And I'm not saying to go back to that, but it's kind of funny, why did we go there? Well, we went there because we wanted to stimulate the economy. This was 2005 and 6, things we weren't sure what was happening. And I mean, it was crazy. I think that was going overboard. Look, my opinion is we're going to disagree on this, Ted, I think a little bit. That's okay. Otherwise, what's the point of talking? We can have a discussion, but I don't see a problem with going, 30-year, 35-year amortization. I think it's good to encourage home ownership. I'm not saying necessarily, use the home as a bank, piggy bank, a savings account, which is, again, the U.S. does this too well, if you know what I mean. I'm saying it's probably not, we should, I don't know, I'd like to see, I'm one voice, but I would like to see, the government maybe say, okay, let's encourage home ownership because we know people that own homes, there's a sense of pride. There's more responsibility. And as you mentioned, the arrears levels are low. Historically in Canada, we're pretty good with the arrears levels, paying our mortgages. We pay our mortgage on time. So I'd like to see that. I don't know. You might not agree with that, Ted, but what do you think about that?
I could see a situation where tinkering with amortization rates makes sense. So if we're up against the wall or in a corner where, everybody's defaulting, take the extreme case. There's a shock that, and this shock really pushes that unemployment rate up, and people just can't stay in their homes. They can't make those monthly mortgage payments. Um, is there an opportunity to refinance using a longer AM? Absolutely, because the benefits of doing so, given that there is a collapse just lingering around the corner, the benefits far outweigh the costs in that situation. And what are the costs? The costs are that you stimulate demand again, which contributes to eventually higher prices and eroding affordability. I think the benefits far outweigh the costs in that scenario. But we're nowhere near that dire scenario. As I say, arrears rates are near historic lows. They will be moving up, but they're still near historic lows. We're not in that situation, yet. And so I think that by tinkering with amortization or making it easier for borrowers to get into the market, you're running the risk of pushing prices up more than would be desired. And again, you're back to the problem that you're trying to solve, which is to keep affordability from eroding, or prevent affordability from eroding. Um, there's I don't want to get too technical, but there is some, we've developed some probability models that kind of tell us a lot about um, when the risk or likelihood of a price correction is highest. And we have all kinds of factors that help explain when there is a risk of a price bust period. And sure enough, anything that restrains debt, anything that restrains loan to value ratios, GDS ratios, TDS ratios, actually reduces the likelihood and probability of a deep price correction. That is, and it actually creates more stability longer term, which everybody benefits from, including prospective buyers who want to get in to the housing market in the future. So there is some short-term, what appears to be some short-term pain, but the long-term, medium to long-term benefits far outweigh um, the the scenario where people feel they're being shut out. But the reality is they are being given a little more time to build savings. And going back to financial literacy, nothing wrong with building savings, taking more time, and then coming back in with, hey, maybe a 10% down payment that cuts your insurance premium in half, and really creates a monthly payment which is more manageable. At the same time, it allows you to probably build equity and pay down that mortgage faster. So, we have to balance short-term versus longer-term benefits and costs, and I think that that there is a longer term benefit that people don't want to. It's not that they don't want to look at it. It's not in their immediate sight, because what's in their immediate sight is the here and now. Um, uh, and just one last thing, Steve. The other problem with higher debt, uh, even good debt like mortgages, is that if you're allocating a good chunk of your operating budget to your monthly interest and principal payments, then that means there's less money left in the future to buy all the other goods and services. So the economy is going to feel that effect. Eventually, there's going to be a second round impact to the economy. Um, and I would argue we're already seeing that second round in recent years, because consumption was growing in real terms at a 4% rate a few years ago. Well, even before the pandemic, it was cut in half. Why was it cut in half? I would argue, your debt servicing costs, your operating household budget, a big chunk of that was just going towards paying debt, both mortgage and non-mortgage. So the economy was feeling that effect. So there's no free lunch. You may think there is in the short run, but in the longer term, this could catch up to us in the form where the economy isn't growing enough to support the housing market. And of course, that there's another feedback effect back to housing there as well. So anyway, all to say, I think we have to strike a balance.
Yeah, and to your point, it's only been about 25 years since we had this 5% down policy. It used to be 10%, and before that, in the early 90s, so I can't remember exactly when, it used to be you could borrow 90% of the first 200,000, and then I think 80% of the balance. So to your point, the bigger down payment, I'm on side with that. The 5% down is basically you have nothing. You might as well make it zero down, because 5%, zero is the same thing. 10%, now you're talking a little bit more. People have skin in the game. I do like that. But I also like the long amortization, and we can debate that later or another time. Moving on here. So some of the trends in financial literacy. So yeah, I mean, what are you seeing there, Ted? I mean, it's a 10th anniversary, and I'm laughing at that, because it's 10 years. That's crazy. We should be talking about the 100th anniversary of financial literacy, but we're only talking the 10th anniversary. And this is put out by the government, and it's the Financial consumer FCAC is Ted. I can't think of it now. The
Federal Consumer Agency of Canada. Yeah.
Yes, thank you very much. And so they have a good site, by the way. If you go on there, some good information on their website. Um, um, I mean, we need to talk a little bit more about that, because I don't know. What are you seeing? Are people getting more aware, or they're becoming less aware when it comes to literacy?
I think, the OECD actually puts out surveys, surveying adults and even younger households, younger folks on, on their financial literacy. So there's a survey that tries to measure their literacy. And, it's not all dire news here. Canada ranks pretty good on an international scale. When it comes to financial literacy. We're in the top quartile of countries out there. So we score fairly well. Where things break down a bit for Canada is that the average consumer isn't aware of how certain things work. So it's pretty important things like, how does compound interest work? What's the difference between the term of a mortgage and the amortization period? Um, um, and even with respect to budgeting, the value of budgeting, there doesn't appear to be a lot of thinking behind this. Um, how much money should you set aside? Uh, how much of a rainy day fund should you set aside in case a shock hits in the future? Are we putting enough money aside for those uncertain times? So we don't score as well in these areas, and so there's definitely more work to be done here. Um, and I guess, Steve, one thing that's sat with me for a long time is a conversation I had with my mother in the 1970s at the dinner table. And we were just having dinner that night, and I'm eating my dinner, and then from the corner of my eye, I noticed my mother jotting things down on a dinner napkin. And I turned to her and I asked her, what are you doing? What are you writing? And she turned to me with stress in her eyes, and she said, I just want to make sure that the money coming in is enough to pay all the bills. Now, that may not mean a lot to people who are online right now listening to us, but that was a very blunt message to me at a very young age, that you need to strike a balance between consumption and savings. I understood it how old was I? I think I was 10 years old at the time, but I understood it, and it was a blunt message. And guess what, Steve? My parents came to this country with $5 in their pocket, and you've heard the story. Everybody knows the story. They had no formal education. They had no computer. And my mother certainly didn't have Excel, where she was putting a budget together in a spreadsheet. They had none of that. But yet there she was, in a crude way, engaging, building a budget, right, on a dinner napkin. So my point here is, if she can do it, anybody can do it. Okay? That's the message, right? It doesn't take, you don't have to turn the world upside down to put something simple together. It doesn't even have to be in a spreadsheet. You can jot it down on a piece of paper, income, expenses on a monthly basis. So I think we definitely have more room for opportunities and improvement here, because as I said earlier, 52% of Canadians do not have a budget. And this is a number from the Federal Consumer Agency of Canada. And I would say, and it came from a survey. So, you know how surveys work. People are less likely to be honest. They're less likely to over-report that they have a budget than to under-report. So I suspect that number is probably higher than 52%, that more than 52% of households do not have a budget. And we know what happens when you don't have a budget and you're trying to buy a home. We know what happened in Vancouver and Toronto. between 2015 and 2017. So I'll leave it there.
No, that's a good, it's a good point. 50%, I'm shocked that that many people would have a budget. I mean, seriously, I have thousands of clients, and they just don't. They just don't have one. They might have one mentally in their head. They think, you know, I have make this much money and I'm putting this much towards my car payment, my mortgage, and so forth. But uh, it doesn't have to be fancy, as you said. Even just, you know, write something down. If you don't even want to put it on a computer, if you're afraid of a spreadsheet, that's fine. I don't care. Have something. Just do a little review. That exercise, by the way, and I found that very helpful, just going through the process of writing it down. Um, it's enormous, and it gives you sort of a roadmap. It gives you a plan to follow. So I would encourage everybody to do that 100%. If you don't have a budget, there's tons of them. Just Google it, type it in. I have all kinds that they're happy to share with it with you. Put one in place. Just have like a roadmap, if you will. Okay, so just a couple more things here, because we've got about 10 minutes left. Disruptions coming post-COVID and the importance of financial literacy and skills. Disruptions post-COVID. I mean, you touched upon that already, Ted, a little bit earlier when you were saying about what's going to happen. Unemployment, it's probably going to go up again for many reasons. The life support that the government's been putting us on, with the financial support that is, that's going to run out at some point. We can't just keep writing checks. And I mean, we're hoping that COVID's going to be gone completely in the vaccine and everything's great. I don't know how realistic that is. I've attended some webinars with epidemiologists and an economist together, by the way, that was a kind of an interesting one. You know, they're not as optimistic, and not to be a downer here, but this is going to be around for a few years. We need to plan to you know, get through this, and we have to be realistic. What are you seeing, Ted, over the next you know, year or two? Or can we even think beyond that?
So if we've learned anything from COVID-19, it's that we need to plan better for that unexpected event. We've had a lot of households who were living paycheck to paycheck prior to COVID-19, and a lot of these households had no plan. If you don't have a plan, if you don't have a budget, then you're unable to manage those risks well when a shock hits. So we saw it, very blunt. Uh, and so the question becomes, what did we learn from this experience, and what's coming? So what's coming are further disruptions. I have suggested there are three. There is the digital economy that's we're in right now that could displace between 30 to 50% of jobs in the future. So that's a disruption that we need to plan for. The second, of course, is debt, right? Debt's a problem today. It's only going to become a bigger problem tomorrow. And so we need to plan for that. And of course, an aging society, a third factor that we need to keep in mind. So what this all means is that, you know, we need to put tools in the hands of the next generation to manage these risks. So whether it's you know, in the education system, you know, embedding more financial literacy courses, because right now, financial literacy isn't really mandatory in the school curriculum. There are some courses there, but you know, clearly more can be done. So putting those skills in the hands of youngsters very early on in life is very important. I think they should start taking baby steps at the age of 15, right? Start to plan, start to think about you know, things that are maybe coming down the road: student loan, auto loan, mortgage. I think the age of 15 is a really nice age to really start thinking about these things. Most people have some income coming in. They've started working at the age of 15, but also it's about really embedding in the school curriculum, embedding more skills that I think will be very critical moving forward in this digital world. Getting this next generation ready, because as I say, uh, this digital revolution we're in, based on what previous revolutions we've been in, industrial revolutions, we know a bit about what to expect. And I think preparing for that is critical. Preparing for debt is critical. Um, obviously, um, it's all about building a plan, Steve. And in the chapter, I've kind of highlighted some of the strategies that one could put in place to help manage those disruptions, those risks moving forward.
Speaking of the chapter, I want to make sure a couple of books here that I want to talk about. First of all, your book, you co-authored a book, Ted, called Property Trendsetters. You can get it on Amazon. You talked about the digital economy. And I really enjoyed reading this, and I liked your little personal experiences that you shared about your family growing up. Um, can you just very quickly maybe talk to us a little bit about, um, you know, well, a couple of things that I saw. Maybe you can just address this because it might be too much here. But middlemen jobs and are they going to go extinct? They're going to go extinct or improve, as you said. And you also said something about realtors. They're back, right? Because people are using them more now than they were just a couple of years ago. If you could just touch upon that.
Yeah, I think some of the functions of a realtor have been displaced by technology for sure. But some of the surveys we've conducted recently suggest that um, in volatile markets, in periods of uncertainty, a lot of potential consumers see value in dealing with a realtor, helping them get that best price for their home, helping them price that home properly. So a lot of these functions that realtors have been providing in the past, those won't be going away. But clearly, being able to access data, being able to see a property virtually, a lot of this will be in many ways taken over by technology in the future. But realtors here to stay. They're not going extinct. There is clearly value there, particularly during uncertain times as we live today. Um, so the big thing is technology is going to make people with task-oriented jobs very vulnerable. Those who basically build their sort of social and emotional intelligence, consultants, people in the healthcare industry, um, you know, mediators, um, even specialized trades that can't be replicated by technology. These are the kinds of skills that are going to be very, very difficult to replace by technology. So the chapter really goes into, what are those skill sets, and how do you make yourself, less vulnerable in the next decade. So I'm really speaking to Generation Z here. The youngest in and around 10 to 12 years of age, the oldest about 24. But you've got this core of Gen Zers in this 15-year-old age category, which in my view is very critical because that's the age where I think a lot of this planning needs to begin. As I say, well before that credit card comes into the picture, that student loan, that car loan comes into the picture. I think the age of 15 is where things really have to start, even if it's baby steps. So I think that having a plan helps us sort of manage those disruptions, those risks. And I highly encourage people to maybe get their hands on this book. There's a lot of gold nuggets in there. All the proceeds go to charity, by the way, Steve. Nothing, I don't see any of this. It's a great charity that we're supporting, but I think it's some useful tips with peppered within some of my own personal experiences.
Yeah, actually, it's on Amazon. I encourage everybody to check it out. You won't be disappointed. I liked it very much. I'll give you one more book that it's an old classic that I want to leave. We talked about this earlier. It's called The Richest Man in Babylon, written in 1926. It's seven simple rules, like saving 10%, stuff like that. Check it out. I think you'll like it. On that note, Ted, I think we're at that hour time frame here. So I want to talk about TFSAs and stuff like that, but we didn't have enough time here. So maybe we can do this again in the future. There's certainly a lot more to unpack that we didn't get into, but I want to thank you, Ted, for taking the time to speak with me again today. And I hope everybody enjoyed it. This will be uploaded again for you to watch, so we'll send out a notice. And if you have any questions, everybody has my email. I don't know if they have Ted's, but I can put you in touch with Ted. I know he's approachable and he does speak to people. So if you have any questions, feel free to send those in to us. Ted, thanks again for joining me. I really appreciate you taking the time.
No problem. Thanks for having me.
Take care, everybody.